In Chapter 4, we will start studying maybe the most famous economic model of markets, which is the supply and demand diagram. Supply and demand is the phrase that economists like to use the most, and that even non-economists like to quote oftentimes. So in this chapter, we will see the neatness of the idea of interaction between consumers and producers in economic markets. We will study competitive markets up for the next few weeks. And later in the semester, we will turn to less competitive forms of markets, monopoly, oligopoly, and monopolistic competition. So in the next perhaps 10 chapters, you should keep in the back of your head that we are assuming competitive markets. By that we mean that there's a sufficient number of consumers, sufficient number of producers. Both producers compete among each other to sell their product. Consumers compete among themselves to buy products at the lowest possible prices. Both consumers and producers act as price takers. Because individual consumers and producers are small relative to the overall size of the market, they take the market price as given, and based on this market price, they choose how much to produce and how much to consume. Later we will say that that's very, very different from monopolistic markets, where one side of the market, such as the producer, can choose both the price and quantity offered, and the other side of the market, consumers, have to accept that price and cannot negotiate that price. As a side note on monopoly, we will also look at the case of monopsony, which is the case when when there's a single consumer who has a market power and is facing a large number of producers, and because the consumer has market power, he can choose perhaps a price which is lower than a competitive price and can force the producers to accept that price. The example of this kind of market would be a labor market in a small town where there is a single employer. And remember that an employer is a consumer of labor of individual workers. And so if the company is facing a large number of workers, but all the workers want to get a job at this particular company, this company would have a market power. We would say a monopsony power. So monopoly is the extreme form of markets where we would say there is no competition on the supply side or on the demand side. Then between competitive markets and monopolistic markets, there are intermediate cases, which we will study in chapters 16 and 17, called oligopoly and monopolistic competition. Let's start with monopolistic competition. In that kind of industry, we still assume that there are many producers, many consumers, but each producer sells a slightly differentiated product. And because there are differences between products of different companies, each company still has a little bit of market power and can choose price which is a little bit different from a competitive price. So because products are differentiated, consumers are not indifferent between individual products, and each producer has a little bit of market power. In oligopolistic markets, we would say that there are few sellers. It can be 2 sellers, 4 sellers, 10 sellers, relatively small number of sellers, and there is competition between these producers, but the competition is not too aggressive. Companies recognize that there are few competitors and they don't have an urge to undercut each other's prices as much as in a perfectly competitive market. So in any market, regardless of the amount of competition there is, we have a supply side and a demand side. In this chapter, we will introduce what do we mean by demand in the market, what do we mean by supply, and how these two sides of the market interact with each other. We will represent the amount of demand by consumers by a demand curve, and the demand curve will show us the quantities that consumers want to buy at a particular price. We will say that the demand curve shows us the willingness and ability of consumers to pay prices for certain quantities of goods. And this demand curve will usually be a downward sloping line. Intuitively, we should think that the relationship between quantity demanded and prices should be negative. The lower the price of a good, the greater the incentive of consumers to buy that product. And we will say that the law of demand gives us this relationship between prices and quantities demanded. Let me give you a simple illustration of a demand curve. Generally, economists draw the relationship between prices and quantities on this kind of graph. We put price on the vertical axis, quantity on the horizontal axis, and we could draw a demand curve as a downward sloping line on this graph. And you should think that each point on the graph shows us the willingness and ability of consumers to pay for a particular quantity of the product. And if we could discuss the change in quantity demanded between 2 points on the demand curve. We would say that the quantity demanded will increase if the price of the commodity decreases. When we discuss demand, we could also talk about changes in demand. When we talk about changes in demand, we're actually talking about shifts in the entire demand curve, either to the right or to the left or up or down. Right? So here, you should be very careful distinguishing changes in the quantity demanded, which implies a single demand curve along which we are moving, and a change in demand, which implies a shift in the entire demand curve in some direction. We will say that there is a number of factors that could shift the entire demand curve. Let's look at an example: consumer incomes. If consumer incomes increase, we would say that if a commodity is a normal good, we will define normal goods as commodities for which, when income increases, quantity demanded will increase for any price. In that case, we would say that the demand curve will shift to the right, because for whatever price is in the marketplace, with the higher incomes, the consumer will demand more of the commodity. Another side note I want to make is about taxes and subsidies. This one factor is not mentioned in the textbook. All of the discussion about taxes and subsidies is on the supply side of the market, but we should think that if the government introduces taxes on buyers, that could influence how much consumers are willing to pay for each unit consumed. Let me illustrate it. Suppose we start with a demand curve for a product, and suppose the government introduces a tax on buyers. The question is, what would happen to the consumer's willingness to pay? So suppose that in the beginning we were at a point like this. The consumer chose to buy, the consumer wanted to pay this amount for this quantity of the product, but now that the consumer also has to pay a tax to the government, he would be willing to pay less to the company than originally. Now that the consumer has to pay taxes, he has to pay both a price to the producer and also a tax to the government, and he would be willing to pay less in the price to the company. We would say that the demand curve shifts downward by the amount of the tax. The consumer would be willing to pay exactly this much less for this commodity because of the new tax. Let's discuss the supply side of the market a little bit. By the law of supply, we will say that the supply curve in the market should be upward sloping. And again, this law is quite intuitive. We would expect that if prices in the market increase, the producer has more incentive to sell products, and he would be willing to sell more units of the good. So the relationship between prices and quantity supplied is positive. Just like for the consumer, we had a list of, we could discuss changes in the quantity supplied, which are the movements along an existing supply curve. And we could discuss changes in the overall supply, which means that for whatever the price is in the market, the producer would be willing to produce more or less than before if some of these factors changes. So now we have looked a little bit at the demand side of the market and the supply side of the market, and we can introduce the law of supply and demand, which tells us that in the solution to the market price adjusts so that quantity demanded is exactly equal to quantity supplied. If the market price is above this level, we may think that quantity supplied would be greater than quantity demanded at that price, and you may think that we would have an excess, we would have excess supply of products. There would be too many products in the market that consumers don't want to buy. This would create pressures on producers to lower their price. Producers would be willing to cut their price a little bit to sell these unsold units, and eventually price would fall all the way to the equilibrium level. Similarly, if we started at a lower price than the equilibrium, then consumers would exert pressure on the market. They would be willing to offer producers a little bit higher price for the right to purchase the commodity, and eventually the market price would adjust at the equilibrium level. Finally, now that we've discussed changes in quantity demanded, changes in quantity supplied, and that we discussed changes in the entire demand and supply schedules, we can we can discuss what would happen to the market solution. If we have a particular change on the demand side and a particular change on the supply side, we can make a simple prediction on what would happen to the equilibrium price and quantity in that market. So to sum up, this was a very simple model of economic markets. This model can be used regardless of the amount of competition among producers and among consumers. We will end up using this model in the majority of chapters in the book. So it is important to understand this basic form of the model.